Welcome back to Smart Stock Sam, the channel where we cut through the noise and find the trades that Wall Street doesn't want you to see. Today, we are diving deep into one of the most jaw-dropping stories in the entire market right now. Ethereum just broke below $2,000, and one NYSE-listed stock has been absolutely obliterated because of it, down nearly 40% this year alone. But here is the question nobody is asking. What if the crash itself is the opportunity? What if Wall Street is making a catastrophic billion-dollar mistake in real time? Stick with me, because by the end of this video, you are going to understand exactly why a single company quietly accumulating almost 5% of the entire global Ethereum supply could be the most misunderstood equity on the entire New York Stock Exchange, and why a mechanical, unstoppable wave of institutional buying could be heading straight for it. This is the brutal truth about the BitMine Immersion Technologies crash, ticker symbol BMNR, and why the algorithms might be dead wrong. Now, if we step back and look at the sheer scale of the dislocation happening right now, the numbers are genuinely staggering. BMNR controls a digital treasury worth $12.3 billion. $12.3 billion. Yet the stock is trading around $18.82, down roughly 40% year to date. The broader market is pricing this equity near pure liquidation value, punishing it almost entirely because Ethereum dipped below that critical $2,000 threshold. But here is what the algorithms are completely missing. There is an imminent, massive liquidity catalyst sitting on the calendar for June 26th that could force billions of dollars into this stock regardless of what crypto is doing. And while we wait for that date to arrive, the company is generating an invisible $276 million a year in pure staking yield. I am going to break down exactly how that yield machine works in just a moment. But first, we have to understand the absolute scale of their ambition, because this is not some small speculative miner hoping to get lucky on a price pop. Management's explicit mandate, stated publicly on the record, is to accumulate 5% of the total global Ethereum supply. Not 3%, not 4%, 5%, and they are dangerously close to pulling it off. Right now, they have secured 4.47% of the supply, meaning they are 89% of the way to their stated target. Think about that. What happens if they actually reach it? Has any single entity outside of a sovereign government ever controlled that percentage of a major global asset? And what does it mean for the price of Ethereum itself when that final accumulation wave hits the market? The key insight here for us as investors is that BMNR has entirely transformed from a passive Bitcoin miner into a high beta proxy for the entire Ethereum ecosystem. If you want leveraged exposure to Ethereum inside your traditional brokerage account, no crypto wallets, no futures contracts, no seed phrases, BMNR has literally engineered itself to be the single largest institutional vehicle to do exactly that. So what does a $12.3 billion balance sheet actually look like under the hood? The composition is striking. The core of their empire is 5.39 million Ethereum tokens. At a recent valuation of $2,134 per token, that single position makes up the lion's share of their total equity. But they are not completely devoid of traditional capital cushion. They are holding $444 million in pure cash. On top of that, they carry strategic equity stakes, $200 million in Beast Industries, another $95 million in 8Co Holdings, and a legacy stash of 203 Bitcoin. From a pure asset perspective, this is a fortress balance sheet. The cash keeps the lights on, the equity stakes provide diversification, and the Ethereum position captures any upside in the world's second-largest cryptocurrency. But here is the thing. If they were just locking those tokens in a cold storage vault, they would be entirely at the mercy of the market. And that is where every single traditional analyst is getting this story completely, catastrophically wrong. BMNR is not a passive holder. They have built an active engine, and they have given it a very American name, the Made in America Validator Network, or MAVAN for short. They have taken 4.71 million ETH, that is 87% of their total reserves, and staked it directly into their own proprietary network infrastructure. By doing this, they have transformed from a passive treasury into an institutional-grade infrastructure provider for the Ethereum proof-of-stake network. And that infrastructure generates an estimated $276 million in annualized revenue, real cash flow, coming in the door every single year. This is not theoretical, projected, or hoped-for revenue. It is the mechanical reward the Ethereum protocol pays validators for securing the network. Every block, every day, paying BMNR to simply hold and validate. They have built a machine that effectively pays them to wait out the crypto winter, and Wall Street is treating that machine as if it is worthless. Now, before we get too excited, we need to confront the brutal macro reality head-on, because things out there are genuinely ugly. We are seeing a massive and increasingly dangerous disconnect between Ethereum's price action and its actual on-chain utility. On the bearish side, ETH has broken below the psychological $2,000 threshold, and that single event has triggered a cascade. Spot Ethereum ETFs have suffered 11 to 12 consecutive days of outflows, totaling roughly $400 to $500 million. Institutional sellers are not just quietly trimming positions, they are running for the exits. Even worse, there is a record $32.5 billion in leveraged short selling actively and aggressively suppressing the spot price. That is an almost incomprehensible weight of bearish capital sitting on top of this asset. But if you pull back the lens and look at the actual on-chain data, the picture is wildly different. Ethereum maintains unmatched dominance in real-world asset tokenization and decentralized finance. On-chain metrics suggest the market has hit an absolute floor accumulation zone at the 1,850 MVRV level, a historically reliable indicator that smart money is loading up quietly while retail panics. The network is being used more than ever before, but Wall Street is aggressively, almost violently, betting against the token itself. This brings us to one of the most powerful and dangerous concepts in all of investing: reflexivity. Famed investor George Soros coined the term to describe how investor perception can actually alter underlying fundamentals, which then alter perception again, feeding a vicious, self-reinforcing loop in either direction. Here is exactly how that loop is playing out for BMNR right now. It starts with Ethereum's spot price dropping because of macro shocks and ETF outflows. That price drop immediately forces BMNR to absorb massive paper losses, specifically an estimated $7.3 billion in unrealized treasury drawdowns. Those numbers hit the balance sheet. Retail and algorithmic sentiment turns aggressively sour, and the algorithms see the headline losses and indiscriminately dump the stock, sending it crashing 40% year-to-date to $18.82. The reflexivity loop is vicious, fast, and merciless. But here is the genuinely strange part that breaks the narrative. Despite this brutal price action, people are trading the absolute life out of this stock. Daily trading volume is a staggering $572 million, making it the 193rd most actively traded equity in the entire United States. When a stock is crashing and the volume is screaming, that is almost never a sign of a company dying quietly. That is a sign of a structural, sentiment-driven mispricing, not an operational failure. And if you need more evidence that this is a mispricing rather than a fair valuation, look at this single data point. BMNR is trading at a price-to-book ratio of just 1.1 times. The U.S. software industry average sits at 2.9 times. BMNR's direct peers, other crypto treasury companies on public markets, are trading at an average of 6.3 times. The market is essentially pricing BMNR at pure liquidation value, as if someone is about to flip off the lights and sell the furniture. You will find automated financial models, websites that use discounted cash flow analysis to generate algorithmic ratings, screaming that BMNR is dangerously overvalued, with some placing a fair value on the stock at one single penny. 1 penny. For a company holding $12.3 billion in real, tangible assets. The reason these models are so spectacularly wrong is simple. They are feeding on $8.68 billion in temporary, unrealized reported losses while completely ignoring the $12.3 billion in actual held asset value sitting right there on the balance sheet. Garbage data in, garbage rating out. This is a classic case of an algorithmic model destroying value for any investor who blindly trusts it. But here is the secret, the one data point that every automated model, every retail seller, and every short seller is entirely ignoring. On June 26th, BMNR is scheduled to enter the large-cap Russell 1000 index. And if you do not understand why that single calendar date is potentially earth-shattering for this stock, let me explain it as clearly as possible. Trillions of dollars are parked in passive index funds and ETFs that track the Russell 1000. These funds operate under a mechanical, non-negotiable mandate. They must hold 20 to 25% of a constituent's market cap. They do not deliberate. They do not analyze Ethereum fundamentals. They do not review balance sheet risks. They simply must buy. Based on BMNR's valuation of approximately $10.75 billion, this translates to an estimated $2.15 billion in forced, blind, price-agnostic mechanical buying hitting BMNR's order book on or around June 26th, $2.15 billion, in a stock that is already one of the most actively shorted equities in the market. Could this be the trigger that launches the most explosive short squeeze of the year in a stock that the crowd has completely written off? The math certainly suggests it is possible. Now, the Russell 1000 inclusion is the main event, but there are powerful secondary catalysts we cannot afford to ignore, and there are serious macro risks that could blow the entire thesis apart. On the bullish side, the legislative environment is shifting rapidly. The Clarity Act just passed the Senate Banking Committee by a vote of 15-9, with its core goal being the permanent legal classification of crypto tokens as commodities. If this bill becomes law, it protects decentralized finance developers from sudden enforcement crackdowns and unlocks a wall of institutional capital that has been sitting on the sidelines waiting for regulatory clarity. That is a major structural tailwind for the entire space and for BMNR specifically. But against that, the macro headwinds are severe. Recent geopolitical instability, U.S.-Iran tensions, strikes near the Strait of Hormuz have revived serious core inflation fears. This forces the Federal Reserve to remain hawkish, keeping interest rates elevated, which drains liquidity from all global risk assets simultaneously. These exact fears wiped out $1 billion in leveraged crypto long positions in a single 24-hour window recently. That kind of volatility is not going away anytime soon, and the company itself carries real structural dangers that we have to be completely honest about. The balance sheet risk is the most obvious. BMNR is absorbing an estimated $7.3 billion in paper losses directly tied to Ethereum's recent spot market drawdown. If ETH continues lower, that hole gets significantly deeper before it gets better. Then there is the regulatory and centralization risk. When a single private entity controls 4.47% of a global cryptocurrency's entire supply, it places an enormous target on their backs. Regulators paying attention to network centralization risks have every reason to scrutinize BMNR with specialized oversight that no other company in this sector would face. Finally, there are the operational hazards baked into the MAVAN staking strategy itself. Staking 87% of your assets creates genuine illiquidity. Smart contract exploits are a real threat. Validator failures can trigger slashing penalties that permanently destroy a portion of staked assets, and withdrawal queue delays on their MAVAN network mean that in a crisis, they cannot simply liquidate quickly. These are not trivial risks. They are real, and they deserve serious respect. So, weighing all of this, the assets, the yield, the catalysts, the risks, what are the actual, realistic outcomes here? The bull case requires Ethereum finding a rock-solid floor at the 1,850 MVRV accumulation zone. The Clarity Act passes into law, opening the regulatory floodgates for institutional capital. MAVAN's $276 million annual yield actively buffers the equity from daily spot volatility. And the highly anticipated Wall Street AI tokenization supercycle finally arrives in full force. In that world, the June 26 Russell 1000 inflows ignite a short squeeze, and a stock that nobody believed in rockets toward a target of $34.50, representing roughly 83% upside from current levels. The bear case, however, is genuinely grim. Persistent inflation forces an aggressively hawkish Federal Reserve to crush liquidity across the board. Ethereum breaks major support at $1,800 and cascades all the way down to $1,500. Spot ETF outflows accelerate as institutions capitulate en masse, and BMNR is forced to recognize billions in permanent, non-recoverable balance sheet impairments that cannot be explained away as temporary paper losses. When I assign probabilities, I place the bear scenario at 20%, real, but not dominant. The base scenario, where Ethereum chops sideways between $1,900 and $2,200, and the stock stabilizes between $18 and $22 on the strength of its staking yield, I assign a 50% probability. That is the most likely world, and the bull scenario, where ETH reclaims its 200-week moving average, pushes past $2,500, and the June 26th Russell inclusion triggers the full short squeeze. I assign a 30% probability, not a certainty. But 30% on a trade with 83% upside is a risk-reward profile that is very difficult to ignore. Before I give you my final verdict, I have to be completely clear. Nothing you hear on this channel is financial or investment advice. Smart Stock. SAM is an educational and informational platform. Every situation is different, every investor is different, and every risk tolerance is different. Markets are inherently unpredictable, and a speculative position in a high-beta crypto equity like BMNR carries real risk of significant loss. Always do your own research. Always consult a qualified financial professional before making any investment decision, and never invest money you cannot afford to lose entirely. These are the rules of the game, and I respect you enough to say them plainly. With that said, here is my final conclusion. Based on the extreme divergence between the underlying asset value and the current equity price, my rating on BitMine Immersion Technologies is a speculative buy. The equity is sitting at a 1.1 times price-to-book ratio, being priced as if it is heading into bankruptcy, while actively generating $276 million a year in real, tangible staking revenue. The play here is to treat BMNR stock as a leveraged, yield-bearing call option on the broader crypto ecosystem, one that comes loaded with a specific, calendar-dated, mechanical liquidity catalyst that the algorithms, the short sellers, and the retail crowd are almost entirely ignoring. That is where asymmetric opportunities live, right in the gap between what the machines see and what the fundamentals say. To recap the dashboard, NYSE ticker BMNR, trading around $18.82, down roughly 40% on the year, price to book of just 1.1 times, $12.3 billion in total assets, 5.39 million ETH tokens, $276 million in MAVAN annual yield. And the June 26th Russell 1000 inclusion sitting on the calendar like a loaded spring, high risk, high beta, highly volatile, exactly where the biggest opportunities usually hide. Now I want to hear from you directly. Drop your answer in the comments below. Do you believe that a single company owning almost 5% of Ethereum's entire global supply is the ultimate asymmetric long play? Or does the concentration risk and regulatory exposure make this an impossible position to hold through the volatility? I genuinely want to read every single response. If this deep dive gave you value, please smash that like button. It takes 2 seconds, and it genuinely helps this channel reach investors who need to see this kind of analysis. Hit subscribe so you never miss a breakdown like this one. And if you really want to support Smart Stock Sam and help us keep producing independent, data-driven research like this, you can now send a super thanks directly through YouTube's support feature right below this video. Every single contribution helps us go deeper on the stories that matter. I will see you in the next one.